You launch your digital product, and suddenly, sales start rolling in from the US, the UK, and Europe. It's an exciting milestone, right until you realize you now have to figure out cross-border tax compliance across half a dozen different countries. If you're an Indian founder, this puts you in a tough spot. You have to decide whether to pay a premium to outsource all that tax math or set up a local payment infrastructure that requires more paperwork but keeps your profit margins intact. This decision usually comes down to two specific paths. You can use a merchant of record, like Dodo Payments, or you can use payment infrastructure, like Playto Pay. Merchant of record platforms market themselves purely on convenience, but what they are actually selling you is heavy international compliance insurance. The question you must ask yourself is whether you are unknowingly paying an 8% premium for global tax coverage that your business doesn't legally require yet. This quadrant chart compares compliance complexity against transaction fees. Top right, merchant of record platforms like Dodo sit high on both cost and complexity. Bottom left, payment rails like Playto Pay offer lower costs, leaving tax compliance to you. To understand that price difference, you have to know what a merchant of record actually does. When you use one, the platform steps in and becomes the legal seller of your product to the end customer. Because they take on that legal seller status, they also take full responsibility for registering your business in different jurisdictions and remitting U.S. sales tax or EU VAT on your behalf. Payment infrastructure takes a completely different approach. These platforms simply process the money moving between the buyer and you. You remain the legal seller on the receipt. Choosing between these two quadrants isn't about finding out which software is objectively better. It's about matching the tool to the exact scale and liability of your business right now. Let's look at the financial input of running your global transactions through a merchant of record like Dodo Payments. The immediate outcome is that they handle the heavy lifting. They calculate the taxes at checkout, collect the money, and automatically remit it to the relevant authorities in the US and Europe. The trade-off for that automation is that you surrender direct control of the transaction. You also have to deal with delayed payouts that typically arrive in US dollars rather than your local currency. On paper, the stated fee structure for an MOR is usually around 5% plus a fixed 50 cents per transaction. But that doesn't account for how the money actually gets to your Indian bank account. Because the MOR pays out in dollars, you have to route it through a service like Wise, which takes another 1 to 2%, or Payoneer, which takes 3 to 5%. This stacked bar chart visualizes the true all-in cost on a $5,000 transaction. The first bar shows the MOR route. You pay about $250 in base fees, plus another $50 to Wise for the payout conversion, bringing the total cost to around $300. Now look at the second bar, representing a platform like Playto Pay. With a flat 4% fee on international cards, the cost is exactly $200. There are zero additional payout fees because the money settles directly. Once you factor in those conversion rates, the MOR model effectively drains between 6 to 8% of your gross revenue. For an Indian business operating on tight margins, that is a massive financial leak. If we shift over to utilizing Playto Pay for your cross-border payment infrastructure, the inputs look very different. The outcome here is a much leaner cost structure. You pay a 1% flat fee on wire transfers and 4% on cards, Apple Pay, Google Pay, and BNPL options. There is absolutely zero Forex markup. You also gain a major operational advantage. The funds settle directly into your Indian bank account in INR every single day, completely bypassing third-party holding delays. The trade-off with this model is that you retain your status as the legal merchant of record. That means you are responsible for utilizing your existing Indian chartered accountant to file your domestic GST. To make that trade-off manageable, Playto automates the Foreign Inward Remittance Certificate, or FIRA. This sample document shows exactly what that looks like: a clear, official record of the transaction with zero hidden Forex markups. By auto-generating this certificate for every international payment, the platform gives your CA exactly the documentation they need to file your GST cleanly and legally. You are already paying an Indian CA a few thousand rupees a month to handle your domestic filings. Leveraging them for your international tax is drastically cheaper than giving an MOR a continuous percentage of every dollar you earn globally. Before you buy into the marketing hype of outsourcing, we need to look at this checklist to see if your business actually generates enough foreign volume to trigger international tax laws. If you are operating an enterprise-scale business, generating beyond $200,000 in monthly international revenue, with heavy customer concentrations in the US and Europe, your situation is complex. At that volume, you are crossing multiple economic nexus thresholds. This legally mandates you to collect and remit taxes across numerous individual states and countries. For an enterprise, the trade-off makes sense. Paying an 8% MOR fee transitions from being an unnecessary premium into a required cost of doing business just to avoid heavy legal penalties. On the exact opposite end of the spectrum, if you are a pre-revenue solo founder with no CA and no infrastructure, you might value pure convenience over profit margins just to get your first product launched. But outside of massive enterprise liability or pure beginner convenience, paying a platform to handle your taxes is over-engineering a problem you don't actually have yet. To help you make a final decision, we can use this flowchart to align your specific business reality with the correct payment processor. Following Path A, if you are doing under $100,000 in monthly international revenue and already have a CA, you belong here. This leads directly to Playto Pay, keeping your fees low and utilizing local tax resources. Next is Path B, for high-volume enterprise SaaS companies frequently crossing U.S. economic nexus thresholds. This leads to Dodo Payments or Paddle. At this scale, swallowing their fee is cheaper than hiring an in-house tax team. Finally, Path C is for the pre-revenue solo founder wanting a zero-headache setup. This directs you to Lemon Squeezy or Dodo simply to bypass the initial administrative friction of setting up a business entity. Regardless of which path you take, there is one unbreakable rule. Never mix an MOR model with a bank transfer-only payout tool. Paying both the MOR fee and the payout fee will completely destroy your margins. Ultimately, your choice of payment processor comes down to a direct trade-off between outsourcing convenience and protecting your hard-earned profit margins. For most growing Indian founders, keeping 96 cents on every dollar through a direct 4% payment infrastructure is the operationally superior move. Leveraging daily direct INR settlements gives you immediate access to your capital, which accelerates your business growth far better than waiting on delayed foreign batches. Choose the platform that protects your revenue today, rather than paying an expensive premium for the enterprise problems of tomorrow.